It's been very, very volatile, like you said. I think we're still going to be very range bound. We've got the weak macroeconomic data on one side, and then,
Camera.
of course, we've got the, Hamas conflict on the other side.
So obviously, two big geopolitical factors having a pretty big influence on the oil market. I also want to talk to you about what's going on here in the U.S. We've seen rates spike. They've eased back now. How much pressure is that putting on the oil market?
I think that's been one of the big drivers when we started to see oil prices move higher. We were definitely expecting prices to kind of stay in the 90s. That's we've been calling for that for a while. Touching or trading into the hundreds is definitely possible. But I think what we've seen is renewed concerns about economic growth, particularly with the rate hikes. Even though they've paused, and we do think the Fed's not going to hike any further, we are starting to see data, macro data, show the effects of higher interest rates. It always works with a lag. Demand concerns are widespread. US oil demand actually is holding up very, very well. European oil demand, on the other hand, does look a lot weaker. But still, we have a much softer demand outlook for next year in our balances already, only expecting 1 million barrels per day of increases versus 2.3 million barrels per day this year. So we are calling for a mild recession in the US, in the OECD overall, and that is going to have an impact on prices. I think what the market fears is that could it be worse than that? Could it actually mean that oil demand doesn't grow at all? We don't necessarily buy into that,
Okay.
but I think those are the concerns we're dealing with right now.
All right, we got some news from the energy market overall, but the oil market specifically yesterday, with Saudi Arabia saying it will extend its 1 million barrel per day cut all the way through December, started in July. Give us a sense. How should investors read that decision by Saudi Arabia? Not a complete surprise, but still making creating some movement in the oil market.
For sure. I mean, look, Prince Abdulaziz has been very clear. And firstly, he had said he's going to extend the deal through year end. So, like you said, it's not a surprise. But the way I think about this very clearly is that he, along with OPEC Plus, are trying to make sure that inventories are low enough and continue to remain low. That should there be a demand slowdown and a recession, let's say the Fed has overdone it, then inventories will start to build. But it doesn't build to the extent that what we had in 2020, which then pushed prices negative. They're trying to keep a very solid floor under prices, which is precisely why Saudi Arabia is leading from the front in saying, okay, we are going to actually cut production and ensure that inventories actually remain very, very tight. So I think
Okay.
that's the objective, is to allow for that buffer should demand weaken.
I want to come back to something we touched on before, rates and their impact on the oil market. Obviously, we have another Fed meeting coming up here in the United States. A lot of people expecting the Fed to pause, maybe end their rate hiking campaign. How important are central banks when it comes to oil? We often talk about their impact on the equity markets, but what about the oil market?
I mean, they're hugely important, not directly, but indirectly at the end of the day, if interest rates are going up and if it actually reduces the ability of people to consume products, oil or otherwise, it has an impact on economic growth and oil demand. But what I will say is that purchasing power is a lot higher today than it was in the last few years. And look, oil prices, be it in the 80s, 90s, or even at $100, is not high if you adjust for inflation. So fundamentally, there is enough there for oil demand to continue growing. I think the risk is with the Fed, where it has taken interest rates and how quickly it's done it, that you're starting to get negative impacts on production, industrial production, on employment. And that's how it feeds through into oil demand, because obviously higher the unemployment, you're not going to get the gasoline demand or even diesel demand from industries, which you would otherwise get. And that's why we are calling for a huge slowdown in oil demand next year.
All right, so I want to come back to what you said. You're forecasting a recession in the U.S. Where does that take WTI in your mind in 2024? This year, a lot of questions to be answered, a lot of geopolitical factors weighing on the market and moving things. But in 2024, where do you see oil going?
So firstly, we're calling for a mild recession. So this is not something that we're not expecting oil demand to fall out of bed. Demand is still going to grow 1 million barrels per day. And that's going to be led by China, India, and Asia is the center of growth. Middle East is the center of growth. It's not the West. So I don't think that actually necessarily weighs on WTI. We're still expecting prices to remain in the 90s next year, precisely for two reasons. One, inventories are super low, and that should warrant a price premium. And secondly, is OPEC Plus discipline, that if there were to be a bigger recession than we're expecting, they will step in. And then, of course, there's downside to our price forecast, but the floor is going to be substantially higher than it has been in the past.